From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. Markets range-bound ahead of the Thanksgiving holiday tomorrow, fluctuating between gains and losses. Yields slightly higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
We begin with the big issue, reading the December tea leaves.
Fed speakers on a daily basis sending some kind of confusing messages.
Market becoming a little bit more cautious on its expectations for the Fed.
We know they're going to raise rates 50 basis points.
50 basis points in December.
Powell prepared the markets for a slowing of rate hikes.
Waiting for that moment when the Fed is likely to pivot.
The terminal rate exploration process.
Are we there yet? Are we there yet? Are we there yet?
We think they're about 70 to 80% done with the tightening cycle.
They're pushing back against the easing in financial conditions.
Keenly focused on the labor markets.
They know that policy works with long and variable lags. They are going into restrictive territory. That is going to continue damaging growth.
The one consistent message from the Fed, there is going to be pain.
Joining us now to discuss is Flowbank's Esti Dweck and Luca Paolini of Pictet Asset Management. And I do want to get to both of you on the year ahead, but just in the here and now. Esti, how important are today's meeting minutes from the November 2nd Fed confab?
I think they're not that important. There's going to be some attention to the dot plot and any discussion of the dot plot and whether that terminal rate is going to come in higher when we get the next update in December. But we've had so many Fed speakers come out since the meeting with very hawkish or mostly hawkish comments. We know there was a slightly more dovish meeting and a more hawkish Powell press conference. I think at this point, investors are looking at it because it's the last big data before the Thanksgiving weekend, but I don't think we're going to get that many big surprises from today.
Luca, it seems like Esti is not alone. A lot of people kind of shrugging past this, perhaps because they don't want to look at it ahead of the long weekend. But are we moving past the Federal Reserve as a controller of markets? Are we moving past the central banks as having some sort of prescience and moving toward the data, the granularity of each individual investor and their thesis?
Yeah, I mean, I totally agree. I think when we look at what central banks are planning to do, I think we know very well what they're planning to do. I think now we have reached a point, especially in the US, where interest rates are pretty much in line with where I think they should be. So now more than ever is about growth, especially it's about inflation, and also it's about inflation expectations. But I think we have reached a point where interest rates, again, are more or less in line with fundamentals. So now it's about data more than ever, and I think what the minutes may actually tell us if the Federal Reserve members feel more worried or less worried about growth than the markets think.
And there's an issue as we look at how the market is pricing in terms of rate hikes, in terms of the Fed stopping at 5%. Evercore's Krishna Guha focusing on that, writing, quote, "We think the Fed leadership wants to get off the 75 basis point a meeting hamster wheel, even though it is finding it hard to do so while maintaining control of financial conditions. We think the Fed is still heading for a hawkish slowing, and the slowing part is what matters." I wonder, Esti, from your vantage point, whether we're really looking at something that is going to be hawkish no matter what, and a market that is eased in terms of financial conditions far beyond what the Fed would like to see.
I think they need to stay hawkish, and their next challenge is going to be, one, saying that tightening is still tightening, even if it's not 75 basis points per meeting, and that 4.5, 4.75, 5%, wherever they end up, is restrictive monetary policy. This higher for longer is restrictive, and they try to maintain that hawkish tone to keep those medium to long-term inflation expectations anchored, prevent those financial conditions from loosening too much, because if that happens, then they're forced to come back and hike some more. So at this point, I think it's more about a balancing act of maintaining that hawkish rhetoric, those inflation expectations in check, and those financial conditions relatively tight, and having that restrictive monetary policy then actually what the rate hike is looking like.
Right, sort of targeting an S&P level. I'm not saying that specifically. It's sort of tongue-in-cheek. But is it, Luca? I mean, how much are you looking at the financial conditions easing in response to this expectation of a slowing inflation, and think that the Fed's going to push back and push back hard?
Well, I do believe that when you look at financial conditions, they're probably going to get a little bit tighter. But I think what really matters for financial conditions is the direction of inflation. And inflation, in my opinion, is going to go down quite significantly. This will help multiples to go higher, so valuation for equity will improve. The real question is that if earnings will decline much more than the PE will rise because of basically opposed by the Fed, also falling inflation. And I think the jury on this is still out. I still believe that earnings will fall quite significantly next year. So I think the Fed really needs to pause for markets to go higher, and I believe that it's too early to make this call, and that's why we continue to be quite cautious on equities, and especially after the rally that we have seen in the past few weeks.
We'll dig into that in just a bit. Just sticking on the Fed speak, we've been digesting a bunch of it, including Kansas City Fed President Esther George, highlighting the need for higher rates.
While high savings is likely to provide momentum to consumption and require higher interest rates, it's certainly positive that we see that these households are wealthier, less financially constrained, and better insured. But that said, reduced inflation will mean we have to incent saving over consumption.
Michael McKee joining us now with more from Washington, D.C. Michael, ahead of those meeting minutes, what are you looking at? What is going to be important for you?
Well, I think Esty Dweck put it well that there isn't much we're going to learn in here. However, the meeting minutes are put together and edited after the meeting, and they have 3 weeks. And I think what you may see is a bit of a hawkish tilt, trying to keep a lid on the financial conditions out there. But here's what we already know. Jay Powell told us the decision was unanimous. The terminal rate was likely to be raised. It may be time to slow the pace. And many feel rates are going to be higher for longer. So there's not going to be any real surprises in there, I don't think, that the chairman and everyone else who's spoken since then hasn't already told us. Now, we are seeing some confusion in the markets about where we go from here. When you look at what the market is pricing for Fed fund futures, it looks like there's a big drop in interest rates, big cuts coming next year. But really, those are about 10 basis points at a time. You don't really get a full 25 basis point cut until November. So it may be that the Fed's message is beginning to sink in. We'll have to see. Finally, how important are the minutes and how important is all this Fed speak? Well, Alan Blinder was just on Bloomberg television saying that he doesn't think the Fed is hurting anybody by talking as much as it does, even though they got a lot of criticism for it. I just want to take you back to when this all started. The first statement from the Fed was on February 4th of 1994. Alan Greenspan put out a statement, and ever since then, the Fed's been communicating a lot more. And look what's happened to the S&P 500. Doesn't look like investors have really been hurt by all this Fed speak.
Yeah, not yet anyway. Michael McKee, thank you so much. Meanwhile, we are getting some PMIs in the United States later this hour following some results out of the Euro region. S&P Global saying, quote, it's clear that manufacturing remains in a severe downturn and the service sector is still under intense pressure. A recession, therefore, looks likely, though the latest data provides hope that the scale of the downturn may not be as severe as previously feared. Still with us, Esty Dweck and Luca Paolini. So over in London, Luca, from your vantage point, we saw better than expected data. How consistent is this with the message in Europe over the next 6 months, 12 months, that perhaps this recession won't be as deep and can be sort of emerged from more quickly?
Well, let me say there is a huge consensus about the recession in Europe. When there is a huge consensus, normally the consensus tends to be wrong. I think, to be fair, though, the risk of recession is very high. But having said that, we see also the consumer confidence data has been improving recently. The economic data is more resilient than everybody expects. And I think for a combination of factors. I think the one is that natural gas prices are going down, which is very significant. You also see quite substantial fiscal policy response. And like in the US, I think there are still excess savings in the system. So I do believe that Europe will go through a recession, but I think it's not going to be particularly severe. It's not going to be particularly long. And the market, I think, slowly is recognized this fact, and European equities has been doing pretty well in the last few weeks because of these reasons.
Esty, do you agree, and do you think that that has staying power?
I agree that some of these factors have certainly helped European equities to do well in the last few weeks. I'm not sure it has so much staying power. We know that growth is going to soften even further, even though so far the winter has been relatively mild and those gas storage levels are much better. I think the lower gas prices were the real catalyst for that upside in equity prices. We still don't know what the ECB is going to do and how it's going to balance this softer growth backdrop with extremely high inflation. So I do worry more about European equities looking into next year. But in the short term, earnings have been relatively supportive, and we do have a little bit of that momentum still going for European equities, at least into the next couple of weeks.
Well, there's momentum for everything right now, Esty. I mean, how much do you buy into this idea that this risk rally can last until the end of the year? I mean, I understand all the gloom and doom beyond, but people are saying, look, people want to make their performance. They're going to be buying, and that's what we're seeing right now.
I think that is what we're seeing, and we're going to continue to have that momentum into the end of the year. We have a couple of very important data points and quite a few sort of soft and hard inflation data points over the next 3 weeks, and that can really help the market. If disinflation indicators continue to feed through into the harder data, that's going to make the job of the Fed a lot easier to at least lift their foot off the pedal somewhat, reduce those the pace of the rate hikes, or at least the size of the rate hikes. And I think it'll continue. Now, as Luca was saying, we have an earnings question for next year. We have those lagged effects from all of that tightening we've done this year, looking at what it's going to do to growth next year. So a couple of big question marks later in 2023. But for the next few weeks, even if it's not in a straight line up, I do think that momentum is going to continue into Christmas.
Luca, final word?
Well, I do believe, though, when you look at the equity market, I think there is too much of a kind of optimism about inflation, about central bank pausing. So I do believe that the next big move is not going to be up and it's going to be down. And I have to say that our hopes are all on inflation falling. And again, we see some evidence of that, but it's too early really to make this call. So I still believe that it's better to be a little bit cautious, to be overweight defensives. And so we don't believe that this rally is really can be sustained for the next 3 or 6 months.
Luca Paolini, Esty Dweck, both of you are sticking with us. Taking a look right now at some of the stocks that are moving ahead of the opening bell. Here's Abigail Doolittle.
Well, Lisa, futures may be stuck right around flat or down slightly right now, but we've got some bigger movers beneath the surface, beginning with earnings movers. Earnings are continuing to come in. Nordstrom, the shares are down about 8%. This after the company reported disappointing earnings. There was too much inventory, too many sales needed, price cutting, plus the current quarter, the holiday quarter, is starting off relatively slow. Autodesk down 8.8%. This after their billings were pretty light. The outlook was cut, and it seems like customers are reluctant to lock up for more than a year. Now, if we flip up the board and take a look at some of the interesting non sequitur movers that are to the upside, Tesla up nearly 2% on an upgrade over at Citi on a better risk to reward after the big fall. While Adam Jonas over at Morgan Stanley used to be a big Tesla bear, now he is saying that this is a big value opportunity. NVIDIA, the chips continue to extend to some degree, a small degree, yesterday's rally. And then Manchester United, a big story stock, up 9.1% on the news. Sort of news, Lisa, because there were trickles of this a couple months ago that the Glazer family may be considering selling its entire stake or a piece of the stake. So that stock up again 9%.
Abigail, thank you so much. Coming up, disruptions and layoffs continuing in the labor market.
In terms of what's happening on the ground, if you think about labor, if you think about housing, all of those things are showing signs of easing at this point.
Credit Suisse, HP now joining the growing list of companies announcing some of those cuts. That conversation coming up next. This is Bloomberg.
We're seeing the beginnings of layoffs, particularly at tech firms and also in the financial industry, fairly large numbers. And that, in time, will be reflected in consumer demand, I think, in next year, particularly discretionary demand.
More layoff announcements coming in across industries. HP planning to cut 6,000 jobs. Credit Suisse slashing at least a third of its investment banking staff in China. Meanwhile, a protest erupting at Apple's main iPhone plant in China as tensions rise over unpaid wages and tough COVID restrictions. Team coverage starting right now. Sonali Basak, Katie Greifeld. Let's start with you, Sonali. What we've seen. What are you seeing?
With Credit Suisse, we know about those job cuts in China, but remember, they also issued that profit warning. That profit would be falling. They would be posting a loss of more than $1.5 billion. 1.5 billion Swiss francs. So we do have shares here under pressure in Switzerland. They are trading below $4, so certainly a scary level to see for a Swiss bank, any large global systemic bank. But again, remember, that profit is not as steep as it was the last quarter. What we're hearing from Credit Suisse is them acknowledging the previously reported extent of outflows at its wealth management business. In addition to that, they put the scale to it, but they also said that investment banking is further under pressure than initially thought and beyond those seasonal declines. So you do have an array of problems. You do have JP Morgan analysts also saying that the fund outflows in particular, Lisa, are concerning. And Credit Suisse, as we know, after the most recent decisions by S&P and the credit rating under pressure here, that they would be facing outflows in that kind of a scenario. But we are learning just how much here this bank is not yet out of the woods.
Sonali, thank you so much. And Katie, we're seeing that pain broaden out. What is going on in your space?
It's broadening out. It's also especially intensifying in the tech sector. You mentioned HP. It cut its earnings outlook, but it also announced plans to cut up to 10% of its workforce. That does amount to about 6,000 jobs over the next 3 years or so. And they're not alone. You have fintech giant FIS also planning to gradually lay off thousands of workers. That's part of a plan to cut about $500 million of costs in the coming quarter. And of course, Google parent company Alphabet, too, is reportedly preparing to lay off about 10,000 of its, quote, poor performing employees. So just a trio of bad news there. But if you look at how some of these stocks are performing pre-market, HP, it seems as if shareholders are cheering those cost cutting efforts. You have Alphabet shares a little bit higher here, and Apple, as you mentioned, Lisa, dealing with protests at its main iPhone plant in China, down a little bit pre-market. And we're talking about tech here, but this is a narrative running through the entire economy right now. You're looking at challenger U.S. job cuts announcements. Obviously, the 2020 bars there kind of blow it out of the water. But as you can see, those bars are creeping higher and higher, Lisa.
Thank you so much. Katie Greifeld, Sonali Basak, both of you, great work. Esti Dweck and Luca Paolini back with us. Luca, from your vantage point, as you see some of these layoffs, is it enough of a softening to really take some of the inflationary pressure out? Do you reward companies that do cut back to prepare for perhaps a tougher next year?
Well, I do see some evidence that wage growth is moderating, which I think is in line with the fact that final demand is weaker than expected. I don't see the risk of a significant decline or an acceleration in job cuts, to be honest, because the service sectors remain very, very solid. But it's no question that companies are making much less money than before. Final demand, or the uncertainty about final demand, is increasing. So it seems to be a pretty easy call to make that job growth will decelerate quite significantly. And I think what will be an impact on inflation? Well, it's difficult to say, because inflation is about wage growth, but also margins. So I think that inflation will continue to fall, but not probably by as much as the market expects.
Meanwhile, we do wonder, Esti, about some of the areas that have already gotten pretty beaten up, have already seen pretty broad layoffs, and I'm thinking about retail. Are there areas where you've already seen such huge declines that they're starting to seem a little bit more attractive?
Well, you mentioned retail for sure. We're starting to see that come through a little bit across in the tech sector. Still a lot of work to do because the announcements are just coming. But I think at some point we are going to see investors give the benefit of the doubt to these companies. I think we're going to see better earnings over the next few quarters. And the fact that costs are being reined in is certainly going to be seen as a positive. As Luca was saying, when you look at the service sector, you still have a lot of demand for jobs. So we're not going to see these layoffs across every sector. And I think, broadly speaking, for the unemployment rate and for the labor market, I think it will prove more resilient maybe than the Fed would like. But then some of these expectations that we have, we talked about those excess savings still coming through and helping people. So we're starting to go in that direction, but overly cutting won't necessarily be the answer. especially if we manage to have something of a short and mild recession.
So, Esty, it seems like that is your base case. You said you ended there with short-lived kind of recession. Is that the base case for you, that we're going to avoid some sort of incredibly hard landing?
At this point, it still seems like a possibility. So base case is a strong word, but if the Fed does lay off a little bit and reduce these rate hikes, and we're coming closer to that terminal rate around 5%, I think that's perfectly manageable. For the economy, we're certainly going to see a slowdown, but the labor market is quite strong. As I said, those savings are doing pretty well. And now we are seeing improvement in the inflation picture, in the supply chains, and that suggests that, you know, things can pick up and the Fed will be able to at least pause at some point. We're not talking about a pivot here, but that should help growth have a softer landing than what's priced in.
Luca, final word?
Well, I think that the most indicators point to a potentially long period of stagnation more than recession. I don't know if it's better or worse for markets, but I don't see a big decline in GDP for a very simple reason, because corporation, but also the consumer sector is now over-leveraged. So I see the risk of a period of stagnation with growth around 0 for 3 or 4 quarters, but I don't see the risk or significant risk of a deep recession in the U.S. in the coming quarters.
Luca Paolini, Esty Dweck, both of you, thank you so much. Have a wonderful weekend if you're taking off starting tomorrow. Coming up, the morning calls, and later, J.P. Morgan's Jack Caffrey urging investors to remain disciplined with diversified portfolios to navigate the volatility. That conversation still ahead on a day with not a lot of action. Markets pretty much flat here with just about 7 minutes to go to the open. This is Bloomberg. With the Macy's Day Parade ringing the New York Stock Exchange bell, this is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Moments away from the start of trading with markets that are not doing very much. You're seeing the NASDAQ flat, S&P down about 0.1%. Yields just slightly higher as people parse through some data. On a data dump kind of day, we are getting a slew of data before the long weekend, including at 10 a.m. University of Michigan consumer sentiment data. We did get a little bit higher than expected jobless claims earlier, and also durable goods orders coming in strong, showing sustained demand in an economy that has been marked by its resilience. Dollar a little bit weaker, 103.30 on the euro dollar, and crude below $80 on the WTI on the NYMEX, $78.29. Joining us now with a look at the stocks moving at the opening bell, here's Abigail Doolittle.
Lisa, let's take a look at the shares of Deere because they are popping on a strong quarter. The company also boosted the outlook. Investors liking this a lot, looking like the best day in about 6 months. And it looks like high tractor sales were really what spurred the quarter. That was a strong quarter along with the outlook. As for what's dragging, because we do, of course, have stocks, well, basically just flat here. Let's take a look at Credit Suisse, which is down 2.2%. Shanali earlier was talking about those layoffs, but they also had the fact that their assets there were outflows of $88 billion, and they're looking at the possibility of a $1.6 billion loss coming up. So more bad news for Credit Suisse. And then oil down on the day, as you know, WTI crude back below $80 per barrel, as you were just pointing out, dragging on the energy sector. And this has everything to do with the EU discussing that Russia price cap at $65 to $70. Not enough to perhaps stem the lack of sales to that Russia oil. So again, oil is down, taking the energy sector with it, Lisa.
Abigail, thank you so much. The retail rally, meanwhile, taking a breather following yesterday's monster move higher. Better than expected results fueling a rally across the sector. Burlington Stores recording its best day in over 9 years. Best Buy jumping nearly 13%, making it the S&P 500's top performer on Tuesday. Joining us now is Bloomberg's Katie Greifeld. Katie, kind of revived from the dead, huh?
A little bit so. Retail, it's really emerged as an unlikely bright spot this earnings season. Like we just talked about, you had Burlington, Best Buy, Abercrombie, all handily beating their analyst forecasts. Add that together, and an index of apparel retailers at the highest level since about January. And most of those gains coming in November alone as we head into a key holiday season. But as with everything these days, you have to adjust for inflation. And when you do that, holiday shopping is actually expected to post its first real loss since 2009. We're talking about a decline of about 1.2%. So keep an eye out for that. And we talked about some of the outperformers, but let's end with some bad news. Nordstrom cut its profit forecast by 12% last night. That's all about markdowns to clear out that excess inventory, which is up 20% from the second quarter. If you look at shares right now, Lisa, they're down about 8% as trading kicks off.
Thank you so much, Katie Greifeld there. Jack Caffrey of JP Morgan arguing that investors are getting ahead of the economy, writing, quote, the economic reality is moving so much more slowly than traders' opinions. It seems much more likely that we have a recession next year, given the host of factors we are seeing that have occurred prior to a recession in the past. We talked about the yield curve before. I'm so pleased to say Jack Caffrey joining us now. Jack, I love this because we have all these people saying, yeah, it might be bad, but it's going to be really good after that. So let's just trade right ahead to that. Where are we seeing markets' opinions getting perhaps ahead of the reality?
Well, I think you started talking about it a moment ago to some extent with retail. Retail does tend to be an early cycle mover. We do know that there should be more people back to work, so probably more people back to office, I should say. But you have this underpinning of where are inventories and where should inventories be. You just mentioned Nordstrom's a week plus ago. We had details from Target in terms of some people just have still too much out there. Looking at some of the bounces in some of the housing stocks, again, early cycle moves, even ahead of interest rates seemingly stabilizing and actually getting the indication that costs of some of those big ticket items, housing and possibly even the auto sector, getting a little bit too far ahead of themselves before you've actually even seen the declines.
So, Jack, how much is what you're saying a sort of reflection of pain that has not yet been realized on the balance sheets of these companies and their forward-looking outlooks? And how much is just a valuation reset in the new era that we're in of inflation and real yield?
Well, I think there are two parts there. And if I were to start with the valuation question, certainly equities have been pressured from a reset to higher interest rates. I think there's been some repricing of a certainty in the Federal Reserve that lasted from the immediate aftermath of the global financial crisis up until maybe late last year, when the Fed insisted that inflation would be transitory and then more or less said, oops, maybe we were wrong. And as they try to recapture that, I think investors are embedding some risk premium for as the Fed trying to offer forward guidance through the rearview mirror. Now, what the equity market still has to work through is what is the earnings impact? And I think that's where the questions get more interesting, because you have some questions about inventory. We've seen that's been flushing its way through the system and somewhat noisily in the equity market. But importantly, a lot of companies have been talking so much about they've worked so hard to hire people that they intend to keep them. And I think that might be supportive of sales, but also might pressure margins. And to the extent that equity investors rely on companies to really guide them towards what the sales and earnings outlook looks like, we might have a better sales outcome, certainly supported by inflation, as we were just talking about. But at the same time, are the profits going to be there as certainly as we would have thought in the past if companies are a bit slower to flex that layoff muscle?
That's such an important point and something we keep hearing about. The job full recession. What is the consequence to margins if that is truly the belief? Meanwhile, sentiment on Wall Street looking ahead to the second half of 2023. As Jack was talking about, analysts seeing the S&P 500 index profits shrinking until then. After that, well, Bloomberg's Kayleigh Lyons joining us now. Kayleigh.
Well, if you listen to Michael Hartnett over at Bank of America, Lisa, he says don't touch risk assets, at least in the first half of next year. And then maybe things get a little bit better as we reach a narrative of peak hawkishness, no more climbing bond yields or the dollar or Fed funds. And then there will genuinely be a bullish turn, which, of course, is not what we have seen in the equity markets this year. And he is not alone in that view. You had a similar view being echoed over at Credit Suisse as well as Bank of America, which sees a bottom coming in the first half. And where that leaves us is really with a tale of two different 6-month periods in 2023, and ultimately a year-end target on average on the street that is just shy of where we trade this morning. 39.31 is the average, and even only 5.5% upside from yesterday's close for the high on the street. So not too much upside is seen next year. And of course, a big part of that story is not just about price, it's about earnings as well, which is what you two were just discussing. If you look at the earnings growth estimates per quarter next year, it is expected to be soft in the first half, actually down about 0.5% when it comes to S&P EPS growth in the second quarter, but then a big rebound seen coming in Qs 3 and 4, and that is likely what all these strategists are looking forward to, Lisa.
KV Lines, thank you so much. And of course, Jack Caffrey, who's still with us, was saying that perhaps people are getting a little ahead of themselves. Do you think that it's because the path to the second half, the more optimism that we're expecting later in 2023, is perhaps a little premature based on it's hard to know what's going to happen in the first half and whether the pain will truly be realized there?
I do think to some extent that we've seen, if we go down the balance sheet, the fixed income markets have certainly been much more enthusiastically of late, particularly the longer end of the curve, that the Fed is going to be shifting its policy sooner rather than later. And at the very headline level, that's true. You've continued to hear Fed speeches about moving away from the 75 basis point rate to a 50, but you're still talking about terminal rates that might be in the fives. A and B, I do think that you're going to, over most of my career, we've certainly seen nominal interest rates along the curve looking more like nominal GDP. So we still have long end interest rates that are still relatively low against what I think most people would suggest nominal GDP might look like a year from now.
Well, this is important, Jack. Are you basically saying that you don't buy this idea of the trade into long bonds, which so many people are saying not only is the consensus, but is the haven bet for next year?
Well, I think it's a haven bet. And as we talked, this idea of being a little bit more balanced. I do think that it is a haven to look at longer duration fixed income, in particular, because where we have seen a move in higher yields, you've actually seen most of that yield recovery in fixed income come in the form of discounts against par value. What that means is that bonds are going to remain very responsive. And we look at where volatility is, fixed income volatility remains multiples higher than what you're seeing in equity market volatility. So I do think there's a case to be made for owning that long duration as a hedge. But I think it's really folding the role as having a hedge for investors who are looking to actually invest in the equity market, where they're going to get their actual longer term purchasing power protection. Finding dividends, growing dividends, and looking the parts of the market that actually benefit from a slowing of inflation and benefiting from some ongoing pricing power.
So where does that?
It's a barbell, if you will, a barbell or a balance.
Where does that leave big tech?
Big tech has been a source of so much in the way of big gains for the equity market for the past decade. But I do think when markets reset and when they come out of recessions, ultimately you wind up finding new leadership. In a world of possibly higher inflation than central banks might be comfortable with, but where they have to accept for political reasons, ultimately big tech, either it shifts its attitude towards defending margins and possibly even starting to consistently return cash, like in particular the semiconductor companies do, to potentially just suffering a bit because so much of the future is a little bit less valuable in a higher interest rate world. So much of that earnings in the future become less valuable in a less certain world where, again, we have this premium about central banks' ability to forecast what the world looks like, and the fact that you actually want to get some of that money back to decide where you reinvest it yourself, not necessarily trusting perhaps some of the technology founders who've reinvested so aggressively in their business with, in some cases, tremendous success, and in some cases, somewhat more mixed results, as we're seeing in some particular parts of the market.
Jack Caffrey, thank you so much. You'll be sticking with us. Some headlines, meanwhile, dropping on the terminal. Here's Abigail Doolittle. Abby?
Well, Lisa, yes, we did have some headlines dropping on the terminal just a few minutes ago. The SEC to push bond and option brokers for better prices on trades. Now, a key part of this looming stock plan may also apply to fixed income. The SEC basically wants best execution for all kinds of trades, more kinds of trades. Now, the big question here, Lisa, is this a nothing headline? Because it feels like the SEC is often pushing for more transparency, better execution for those buying securities? Or is it going to be like 20 years ago when the FINRA put in place TRACE for bond trading? I was at a couple different firms at that time, and it really made it more difficult for the traders because there really was more transparency for the clients. It's unclear right now, but the SEC right now is going to push bond and option brokers for better prices on trades.
Thank you so much, Abby. Yeah, and that 15-minute window potentially being curtailed to shorter for the requirement to report those bond prices. Coming up, U.S. PMI numbers crossing any minute after data out of Europe, pointing to a recession, although with some hope for a shallow recession. That conversation coming up next. This is Bloomberg.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, we have Dana Tesley of the Tesley Advisory Group. That conversation at 1:30 p.m. in New York, 6:30 p.m. in London. This is Bloomberg.
Some breaking U.S. economic data crossing the terminal now. Abigail Doolittle has the details. Abby.
Yeah, Lisa, this is really pretty interesting because we're looking at pretty sizable misses here. We're talking about the PMIs for the U.S. manufacturing, services, and composite. We're looking at contraction for all three. Manufacturing came in at 47.6. The expectation was 50. That's below what the ISM manufacturing number came in, which I think it was around 49.2 for the last month. We have services in at 46.1. That's also interesting because a lot of folks thinking that if we're in a recession, it's not a real recession because services holding up. And then the overall number, not surprisingly, coming in at 46.3. Now, also interesting, Lisa, of course, we have stocks up a little bit on this, up 0.2%. That idea of bad news is good news. But it's very interesting what you were talking about before, this deep inversion for the yield curve. As you know, this usually portends a recession. Could it be the brief one that we have maybe seen, not seen? Maybe the case is growing for the idea that economic growth here is, in fact, slowing in the U.S. and that there could be some sort of a real recession ahead. But again, these PMIs in the U.S., the preliminary numbers for the month of November missing across the board, coming in at overall 46.3 contraction.
Which is a contraction, exactly. Abigail Doolittle, thank you. And I do think it's notable, just to pick up on what you were talking about, Abby, that bad news is good news for markets. You are seeing yields lower across the board, and you are seeing just a sharp move lower on the 2s through the 10s. And then again, the pop in stocks, because yes, once again, people are hopeful that perhaps this will give the Fed confidence to move away from some of their 75 basis point rate hikes and their hawkish tilt. To dig into the data in the U.S. and in Europe, here's our own Michael McKee. Mike.
Well, Lisa, it basically just tells the story of a global economic slowdown. The numbers we saw in the United States, pretty much the same as what we're seeing across Europe this morning. The biggest economies there, France and Germany, also seeing numbers in the 40s, although some slight improvement, not something that you're going to write home about. But at least France and Germany go up a little bit compared to the prior month. But they're still in the mid-40s for not only manufacturing and services, but for the composite. The Eurozone in the same situation. And the UK is kind of the surprise in the sense that those numbers look awful, but they're not as bad as had been forecast given the outlook for the British economy. So right now, it doesn't tell us much more than we already knew. Things are not good. The question is, where do we go from here?
Michael McKee, thank you so much. JP Morgan's Jack Caffrey back with us. I am wondering whether we're already in a recession if we start to see some of this recessionary type of data. What's your view on that?
Well, when we come back earlier this year, we wound up having 2 quarters officially of negative GDP. Underpinning that, though, is the sense that the consumer had remained strong. And I think that's certainly one of the issues that we have to try to take apart. How much is changing consumer behavior from jobs and their spending? How much is, to some extent, inventory adjustments working their way through the system? Either people are comfortable with their inventory levels or are actually seeing their backlogs beginning to fall. And as a result, those companies wind up cutting their own orders and working their way through the system, reflecting why those PMIs, particularly in the manufacturing sector, have come in a little bit weaker. Now, that's not necessarily shocking overall. So I do think that the consumer remains reasonably resilient. And the question then is there some issue of where there's over leverage in the economy? You know, where you had a housing situation in 2004, 5, 6, 7, or perhaps overinvestment in the communication sector in 99, 2000. We don't have those misalignments of capital, that excessive borrowing, at least it would seem at the consumer and corporate levels, maybe the government level, but then again, governments influence our central banks. So more likely to be more political pressure on central banks to be somewhat accommodated. Not answering your question, but I do think slowing. But, you know, there's a difference between the economists on one hand and the other. But let's keep watching the consumer, because the consumer certainly is willing to engage and spend. And that really is a driver of 70% of the U.S.
Is bad news good news for you, though? Does it give you any confidence to go out and dig into stocks at a time when the Fed is still tightening but might rethink the pace?
Well, I think that comes back to where we started this conversation. Bad news is what's given particularly the fixed income markets and where we've seen some pops. The idea that the news is so bad that the Fed is going to recognize that they perhaps over-tightened and can move us towards this discussion of an eventual easing. I can't really hear anyone talking about when the easing starts. So we haven't really gotten to the point where bad news has become truly good news, that the Fed has recognized that they've overdone it again. So with that, bad news might make for a less aggressive shift in the fixed income markets. Equity markets can look to that for some comfort. And then ultimately, we're going to come back and, guidance is winding down. And the sense of what corporate earnings start winding up looking like, the first and second quarters are likely to be driven by this sense of how much inventory is really out there and how much inventory do we need before we can actually flush that and actually start seeing some real demand really reassert itself.
One confusion in 2022 heading into next year has been the energy sector, because you have this decline that we've seen that's pretty dramatic in oil prices on the heels of potentially a slowdown in demand, a slowdown just in the global economy. And on the other hand, you're seeing that resilience. You're seeing the lack of investment in a lot of the companies that need to produce some of the goods, that need to produce oil, that need to produce copper. How much do you go into commodities now, despite some of the speculation that we're going to see a decline in activity?
Well, I think there's an old adage among traders that high prices are the cure for high prices. And so, that high prices results in consumers beginning to economize. I think that's certainly the fear you're seeing in energy. Isn't something you've seen necessarily in some of the other commodity markets yet. But those high prices are a function of underinvestment. And I think that gets to the real intermediate term question, where you are seeing two very different responses. And I think it's a timely question to have coming after the COP27 discussion. And you look at European energy stocks, and they are changing themselves from being oil companies to power companies, investing very aggressively in terms of how they will generate and provide power on a going forward basis. In America, the attitude seems to be, I'd almost say the oil stocks are looking like tobacco stocks 20 or so years ago, when they recognized that they might not have the growth going forward that they've had in the past. They're going to generate a considerable amount of cash with a more disciplined spending profile, and returning that cash to their investors and letting their investors decide whether they might find investing in solar is the right idea, investing in wind power or transmission systems, or just buying a completely different business. Or if you really believe in energy, you can buy more of the oil stocks, along with the companies which are retiring their shares. So there is an obvious split in energy. Clearly, we need it, when it's 27 degrees in New York when we wake up on Monday morning and thinking, where did summer go?
Indeed. Jack Caffrey, thank you. It seems like fall just didn't happen. For some of the sector price action this morning, let's get to Bloomberg's Abigail Doolittle. Abby.
Well, Lisa, the volume may be 40% below the 20-day average, but we are looking at a gain now for the S&P 500 of 0.4%. Not surprisingly, most of the sectors are higher, of course, driven by those weaker PMIs, consumer discretionary, technology, and communication services up top. Over the last 5 days, though, Lisa, let's take a look at the contrast between discretionary and staples. Staples risk off leading, discretionary is down. It's going to be interesting to see whether or not this reverses as we go into the year end, and will we have a Santa Claus rally?
Abby, thank you so much. Coming up, the market moving events that you need to be watching. That's next in our trading diary. As Abby was saying, we are seeing a rally. Bad news, evidently, is good news, at least for now. This is Bloomberg. Lisa Robinson for Jonathan Ferro. We are seeing a lift to markets after disappointing PMIs. Bad news is good news. S&P up 0.4%. NASDAQ up nearly 0.75%. Yields are lower because perhaps people believe the Fed will be able to move away from some of their rate hikes. Time now for the trading diary. What you need to be watching: new-ish consumer sentiment coming at the top of the hour. New home sales continues the host of data today. Fed minutes out at 2 p.m. U.S. markets closing for the Thanksgiving holiday on Thursday and a shorter market day on Friday. Happy Thanksgiving to everyone who does celebrate. I hope you enjoy it with your families, with your loved ones. This was Countdown to the Open. This is Bloomberg.